It is no secret that in recent years, inflation has been a hot topic. Home values, commodities, even the price of a cup of coffee all have gone up. And we're not even going to talk about the price of eggs. But what does this mean for your stock investments? What does inflation do? How does it affect stocks? In today's video, here is what you will learn. 1, what inflation is and why it's important to understand as an investor. 2, how our government measures inflation using the Consumer Price Index, among other metrics. 3, the connection between inflation, interest rates, and the stock market. And 4th, you're going to learn some practical strategies that will help you make better investment decisions during inflationary times. So what is inflation? If I were to stop the average person on the street and ask them what inflation is, they would probably be able to explain to me that inflation is when the prices for goods and services are rising or rises. And what it really is at the root of it, it is the dilution of our purchasing power, the dilution of our money over time. It's kind of a chicken and egg question. Did prices go up? Did the products, goods, or services become more expensive? Or did our currency become less potent, less valuable? In simple terms, your dollars today don't stretch as far as they did a year ago. In fact, my grandpa used to tell me he could buy a loaf of bread for a nickel. And I thought to myself when I was a kid, that is amazing, a whole loaf of bread for a nickel. And as I grew older, I started to understand back in Grandpa's day, a nickel was like $5. And so Grandpa was paying like $5 for a loaf of bread. And what happened is the price of bread didn't go up. The value of nickels went down. So why is this important to know? As an investor, inflation influences the economy's health and it directly impacts asset prices, including stocks. Now, I want you to picture and imagine this little glass of grape juice here represents your purchasing power and all the goods and services in the economy right now. If the Federal Reserve Bank were to increase the monetary supply and or lower interest rates, those are really the two levers that the Federal Reserve Bank has. They can control the monetary supply, how much money is in the system, and they can also control interest rates, the rate at which we borrow and lend money. Now, if the Federal Reserve Bank wants to stimulate the economy, they are going to lower interest rates and potentially print more money, putting more money into the system. And if the economy gets overheated and prices rise too fast, they can put on the brakes and they can raise interest rates and destroy currency or pull currency out of the system. Now, remember this glass. This is grape juice, and it currently represents the economy as is. And if the Federal Reserve Bank came in and they wanted to put more money into the system, it's a little bit like pouring water into the grape juice. It's going to dilute the grape juice. Now watch what happens when I pour the water in. This is a pretty simple concept, right? Even a child can understand it. I poured the water in, and you can clearly see that the grape juice is a little bit diluted. It clearly doesn't taste as good. Yeah, that's pretty watered down. It's just not as potent as it was. But the other thing that happened is the level rose. And when you dilute the currency, what happens is the prices of goods, services, and assets all go up. Not because the goods and services and assets are technically more valuable, it's because they put more money into the system, diluting the potency of the currency, diluting our purchasing power, and therefore it takes more currency to buy the same amount of goods and services that we had before. So that is the perfect example of how inflation affects prices. Now that we have a better understanding of what inflation is and the general concept, let's talk about how the government measures inflation. It uses an index known as the Consumer Price Index to measure inflation. This is known as the CPI, the Consumer Price Index. And the Consumer Price Index tracks the price changes in a basket of goods and services over time. And so it measures that basket of goods and services, things that we always buy, like groceries and gas and rent, and the things that we are constantly consuming. It measures the prices of those over time, typically over a 1-2 year period. And it's comparing the prices today to a year ago or to 2 years ago. Another measure that the government uses is called the Producer's Price Index. And this tracks wholesale prices over time, the prices from the producers, the companies that produce and manufacture the goods and the services that we consume. And so by tracking the wholesale prices and the retail prices, we can get a pretty good idea of what is happening to the level of prices for the goods and services that we consume over time. And this provides insight into price trends and the overall direction of the economy. So let's talk about inflation and interest rates. Here's the connection. When inflation rises, central banks like the Federal Reserve Bank often step in by raising interest rates to slow down spending and borrowing. Higher interest rates make borrowing more expensive, which can reduce corporate profits and slow economic growth. This domino effect directly impacts stock valuations and investor sentiment. So what happens is when interest rates rise, it tends to have a cooling effect on the prices of stocks. But that can be good news, because if it has a cooling effect on the prices of stocks, that means the prices of stocks are likely to come down, which means we might be able to buy them while they're on sale. So if you hear news that the Federal Reserve is going to lower interest rates, that typically means that they're worried about economic slowdown, that they've hit the brakes too hard, and now they need to step on the gas. And when they step on the gas, that typically means that they're going to lower interest rates and possibly even print more money and put more money into the system, which can have a stimulating effect on the economy and, of course, the value of stocks. So a real simple way to think about it is, again, rising interest rates will curb inflation. It'll slow inflation down, which includes stock prices. And when they lower interest rates and or print money, or both, that is designed to stimulate the economy, to get people to buy, to borrow, to spend, which will have a stimulating effect on prices, and prices will start to rise, including stocks. There's two rules when it comes to investing. The first rule is don't fight the Fed. When the Federal Reserve Bank tells us that they are going to raise interest rates, we know that that is going to slow asset prices down. And when the Federal Reserve Bank tells us that they're going to lower interest rates over time, we know that that's going to have a stimulating effect on the prices of goods and services and assets, and that the stock values could go up. So now let's break down the relationship between inflation and stocks. Growth stocks, companies in sectors like technology, where they're innovating, often suffer during high inflation because their future cash flows are worth less in today's terms. Investors may shift away from these stocks. Value stocks, companies with strong current cash flows and dividend-paying stocks, tend to perform better as they provide immediate returns. Sectors that benefit the most are commodities, energy, and consumer staples because they're tied to essential goods and services whose prices rise along with inflation. So here's the big secret. The big takeaway from this video. If we know that inflation is a feature of the system and not just a bug, we can count on that. And the simplest decision you can make is to be an investor. Learn to trade your dollars, which are devaluing, for assets that will hold their value and rise in value over time as your purchasing power is diluted. Just like the cup of grape juice. Again, when we pour more water in, that is going to have an inflationary effect, and prices will rise, and it'll further dilute the purchasing power. So the key to growing wealth is to trade your dollars for assets like stocks. You can invest in exchange-traded funds, the ETFs, like the SPY or the VOO, or you could pick individual stocks or even invest by sector. And again, when we understand how the system works, we can make better financial decisions. If you found this video helpful, don't forget to like the video, subscribe to the channel, and hit the notification bell so you don't miss out on future insights. Thanks for watching, and I will see you in the next video.